good years. On the CBOT, you have regular gold, you have mini gold, you have wheat, you have all the other stuff. This is the exchange. You cannot trade on the exchange, you understand that. Only a broker will do that. So what you need to do is actually find a futures broker, and that's where you can open an account. The one that I used extensively for many years is called Man Financial. And manfinancial.com is a highly reputable broker out of Chicago. There are dozens, probably close to over 100 brokers. So that's the one way to invest in commodities on leverage. The other standard way is, of course, with options. CBOT includes not only futures, but also includes options. Now, that is if you want to speculate, and with borrowed money, meaning with leverage. I did that for 5 years. Or the alternative way is simply to invest in the commodity by purchasing it and, keep it in your pocket. So what I did over the weekend on Saturdays, went to the bank, paid 625 Bulgarian leva, and I bought me half an ounce of gold Krugerrand. So this is 1 ounce of pure gold, meaning the coin is a little bit more than that, so it contains half an ounce of gold, 625, and that's the end of it. And then I bury it in my yard, whatever that is, right? So, again, they have only one left and they're running out of them, so I'm gonna go unless someone rushes, right after class to buy the other one, and just get me another one this week. So, the alternative is just buy the gold itself. Now, besides these, there is a third way. The third way is called ETF, which stands for Exchange Traded Fund. This means that some professional manager investment... Oh, you're already recording? Are you?
Yeah.
Oh, I didn't know that. Alright, so this means that some professional investment manager would be managing the ETF, and you will have a gold ETF, for example. And the gold ETF will be called GLD. You'll have a silver ETF, and the silver ETF will be called SLV, and so forth. You have a crude oil, you're going to have a natural gas. So the ETF trades exactly like a stock. To buy an ETF, you do not need a broker on futures, you need a stockbroker. Any stockbroker should be able to, to get you to buy and sell an ETF. Alright? So that's the ETF part. With an ETF, you have the advantage, because you wanted it with borrowed money, to use leverage, and the means of leverage is called margin. On the US stock exchanges so far, the margin requirement, minimum margin, and there are two types of margins. One is called initial margin, the other one is called maintenance margin. The minimum initial margin is 50%. This does mean that you can purchase and invest, meaning speculate with borrowed money on leverage, with twice your money. You put in 5,000, you can buy at most 10,000. No broker will give you more, because it will be a violation of a Federal Reserve requirement that no broker shall allow more than 50% margin. So margin allows you to leverage roughly twice. The futures allows you to leverage roughly 10 times. With futures, you can easily get wiped out. I have been a couple of times. It's a sobering feeling to get your account completely wiped out. in a couple hours or during the opening of the exchange. In other words, the exchange opens a lot lower and the account gets wiped out. Well, you're just going to have like $2,000, $3,000, $5,000, no big deal. No, the problem is when your futures account is a lot more than that. Okay, let's explain this. In terms of risk management, you gotta have some portfolio management, some risk management. As far as I'm concerned, I'll never keep more than 20% in futures, meaning on leverage. In other words, if my, what we call trading account, gets wiped out completely, yes, I will lose 20% of my portfolio. I got two options. Either to replenish from more of my trading account, or the other option is don't do any more, or the third option is, okay, I'm going to save and replenish it. When I was in the US, if my trading account is only $2,000, I mean, this is very high leverage, 10 to 1. If my account gets wiped out, I'd save for a month and a half, and I'm able to replenish it. Then I have, or what you should have, what's called a core position. A core position. Now, sorry, I'm switching back to portfolio analysis and construction of a portfolio. Your portfolio, your core position, should essentially have anywhere from 30 to all the way to 90 of assets which you do not trade, which you hold long term. So the point is that yes, I have a trading account, yes, I have a core position. My portfolio has been looking for the last few years as this. So before I started teaching here in 2005, a 4-course load, which means I couldn't watch the market every 15 minutes because I'm going to be talking to you guys. I had roughly a 10% trading account. My portfolio had roughly 40% silver bullion. These are big, heavy bars, 2,000 ounces, just about your weight or my weight, and this is, here is the key word, fully paid for. That's how it's called in English. Fully paid for means that it is entirely out of savings, no leverage, no debt, no possibility of a margin call, and no possibility of losing the 2,000 plus ounces of silver. So, and then I have real estate. And real estate is tricky. Real estate is, again, do you think in terms of real estate as an investment or in terms as a consumption? For me, it is my consumption. Whether my real estate goes to million or goes to 1,000, it doesn't matter. I live in it and I use it. But in terms of dollar value, it was roughly 50%. Real estate is an investment in the sense that it has no debt, meaning no mortgage, meaning the same thing, fully paid for. So, no matter what happens, I can't lose the house. Again, what happens with the house, 20% up or down is irrelevant because I do not speculate, and more importantly, I'm not on the margin. If you have a 90% mortgage, and the real estate, meaning the price, the value goes down by 20%, you're not only wiped out, but you're also deep in the hole, okay? So, meaning you're sustaining major losses. And these are real losses because, you can't just pay or just keep paying and, nothing really happens. So, again, this is the portfolio. So, we say, well, do I hold some cash? Sure, and cash is probably 2% at most. I don't trust in this financial environment the value of paper currency, Bulgarian lev, US dollar, or euro. These, as you guys know well, depreciate and depreciate fast. I mean, is the euro rising or falling? Rising. Well, rising, you gotta say against what? Against what is it rising? Oh, against the dollar. So you're comparing one piece of paper against the other piece of paper. Well, here is the deal. It's not a deal. The Eurozone, ECB, meaning Jean-Claude Trichet, right? That's Bernanke's counterpart in Europe, is increasing money supply, meaning broad money supply, at 12% a year. So the euro is rapidly depreciating, and the euro is getting rapidly debased. We call it debasement of the currency. How do we know that? Well, euro lost, during the last year, half of its value against wheat. It's lost in terms of real estate about 10% purchasing power. Against gold's lost, how much did we see it last time on the picture? Roughly 20%, right? I mean, gold's up against the dollar 32% in 2007. The euro is up against the dollar roughly, what is it, 13% or 12%. So gold is up against the euro 20%. This means that the euro is down against gold roughly 20%. Well, crude oil is up even more. So the interpretation is the euro is falling and rapidly depreciating. Probably the better measure will be euro against the CRP index, which is a complex of commodities. But there is one big problem with the CRB. Because it is an indicator of inflation. Over the last year or so, the US government has begun to rejigger and change the weights of the CRB so that since the beginning of 2007, even CRB is not a good appropriate indicator of the value of commodities. Because now they put in a larger weight to those commodities that rise the least and shrink the weight of those commodities that rise the most. The objective is to underreport the actual rise of commodities and thereby manage inflation expectations. Ben Bernanke, you know, is overly concerned with what? Anchoring financial expectations. In other words, inflationary expectations are well anchored. We gotta do whatever we can to keep them low. Well, how do we call the process of, maintaining the confidence in the people, in people for, to have low inflationary expectations? All right. So let's get back to your question. So number one is you get on the futures. Number two, you can do it on the options. Number three is you can go for an ETF. And number four, you can just buy the commodity itself. Now, of course, if you're buying the commodity, you can just go in the bank and borrow. All right? You just go in the bank, borrow in dollars. Maybe there are still a few dumb banks in Bulgaria that will actually lend you in dollars. They're reluctant because bankers really feel that the dollar is losing value. So they're reluctant to do that. They say, well, what about if you want to borrow, let's say, in Bulgarian leva? They are reluctant to lend in Bulgarian leva either because they are fearful that the Bulgarian lev will collapse against the euro. In other words, that the currency board will collapse. So they would not want to lend you in leva. You could still go ahead and borrow in euro and then invest, but the question is, how do you invest and how do you maintain the liquidity? In other words, you got to invest in something that you can easily sell at a later time for a minimum loss. All right? So one of the easiest ways is ETF, and whether you choose crude oil, whether you choose natural gas, everything is fine. One of the better commodities so far, one of the best performing commodities so far with the brightest potential is uranium. Copper also has a strong investment potential. As far as I'm concerned, I'm loaded with silver. Now I have roughly 10% in my portfolio is gold. So I've been raising my the gold in my portfolio. Again, I try to maintain financial assets within less than 2 or 3%. So far, I've been doing okay. My silver I bought roughly in the 450 range, and now is in the 17 range. So my silver has gone up 4 times in 4 years. That's a fairly decent investment altogether. Any other questions, guys? None? Oh, question.
You say that the inflation in the EU is very high, and as
Yes.
far as I know, it's less than 2%.
Oh. No, okay. And you don't say, that's the very incorrect statement, say that inflation is less than 2%. What you say is governmentally reported inflation is less. That's the correct statement. In other words, inflation reported by the government statistical whatever institution is reporting. This is true. They indeed report 2% inflation. But every common sense European knows that everything they purchase has gone up a lot more. Wheat is gone up, again, big time. Bread is gone up big time. Crude oil, gasoline, gas, everything, electricity, you name it, whatever the people purchase, it's gone up an awful lot. I mean, it's simple as that. So just because the government reports 2%, it doesn't mean it is 2%. Jean-Claude Trichet is very, very concerned about keeping inflationary expectations tame, because he's afraid that there will be what's called second round inflation. Second round inflation means that once prices rise by 10% and people get to feel it and demand from their employers a 10% increase, whether they get it or not is a different issue. They may get 9, they may get 8. But the sooner that they realize, oh, there's a 10% inflation, we want a 10% increase, when they get the 10% increase, it causes the higher rising prices next year. So you get the inflationary spiral similar from the 70s. The lesson learned from the 70s is once prices rise, workers ask for a raise, they get the raise, this causes the higher price, this causes the raise, and you get into the inflationary spiral. So this means that you lose control of inflation. Well, how? What is the cause of losing control of inflation? It is inflationary expectations. Once inflationary expectations rise, demand for money falls. If demand for money falls, the value of money falls. Well, how do we call the falling value of money? We call it price inflation. We call it depreciation. It's the same thing anyway. So just because it's 2%, you guys should be a little smarter than that and just watch for yourself. I mean, just go to Greece or Germany and see for the last year how much prices have gone up, all right? Any other questions? Any? None. All right, let's get back to where we were. Last time we were on Dow Jones Industrial divided by gold. I have this nice stick. It is not for punishment purposes, just only for education purposes, no discipline. All right, so you see what's going on? I think I showed it pretty much this way last time. You have a long-term trend beginning somewhere in 1980, could possibly a little earlier than that. And you can see the long-term trend was broken in 2002. Now you have a long-term bear market. We call it bear market for financial assets against real assets. You can expect this to last for another 10, maybe 15 years. Very hard to say exactly how much, but we know valuations, meaning the ratio's got to go back down somewhere in the 1 to 2 range in order to have swung the other way around, to have the financial assets undervalued and real assets overvalued. So far the ratio is roughly 20, it's more like 15 these days. So from 15 you got another, the real assets got to appreciate for another 10 times. Let's move on and see what's next. Alright, this is the Japanese yen. This is just for you to give you a flavor, and there are more yen charts down the road. You can see you have late 2007, late 2006, yen going up, down. What this author saw here was a short and long-term support area in the 82 area. So roughly between 82.5 and 83, he saw a support area. At later charts, you may see that area held. And okay, this is what's called in technical analysis a falling wedge. Falling wedge means that it goes down and narrows at the end. And remember, falling wedge is a classical chart pattern for reversal. It actually, if we see a later chart sometime later in the course, you'll see that this held, it was a reversal, and the yen reversed its way up, at least against the dollar. Alright, let's move on and see what's next. Alright, this is the Japanese yen. Again, you see the same chart, similar pattern. You also see the same. What you also see here is this author has provided a different interpretation of the same chart. You here have the support level, again, the falling wedge. From what I remember of the chart, it actually held. Let's move on further, see what's next. Alright, this is natural gas. I think we saw this chart, right? Natural gas, we saw this chart. What this guy saw here was once, twice, 3 times there was a resistance level. Let's move on and see what's next. I think we saw this before. Let's move on further than that. Alright, this is GC. Okay, this is the gold pit. I think we went through these last time, right? Didn't we? I remember these. Alright, so you see here is a trend channel. This is called the internal trend line. Internal trend line is usually somewhere in the middle between the trend channel, and sometimes it holds as an internal resistance and then as an internal support. Let's move on and see what we have. Personal savings, I remember we covered it last time. You have the two trend channels. You see in 1991 there has been a clear long-term reversal of the savings trend, and it goes down further.
What happened then? What happened in 1993?
Oh, well, so in other words, what is the fundamental? Now, first of all, notice that these shaded areas here represent recessions. So, during recession, usually you see a spike in savings. This is the meaning of recession, is that the economy restores its savings rate, which of course means shrinks consumption, and when consumption shrinks, it lowers the GDP. So in 92, 93, from what I understand, that's the SNL final blow up. In other words, they had problems during the 70s. The first initial blow up was in 80 and then 82. Then the government didn't take any action, so they got into the junk bond market. Michael Milken was the superstar. So they loaded up an awful lot, and this is the point where this whole SNL crisis finally blew up, and the government effectively had to use a couple of $100 billion. The current estimate is that the total amount was $300 billion, and $300 billion in 1991 is good $1 trillion today. So monetizing that shock effectively means that if the government's got to print it and give it to them, it has the effect of shrinking the savings pool. In other words, running government deficits is, from at least introductory macroeconomics, lowers the public savings. And total savings, if you remember that, equals private savings and public savings. Public savings is represented by the fiscal surplus, and public dissaving represents the deficit. So anytime you have a bailout of major financial institutions, for which the government runs an extra deficit. That extra deficit is reflected into lower public savings, which in turn, you see, that's the problem of the fundamental problem of the Keynesian approach. You run a bailout, and then a second one, and then a third one, and every time you run a bailout, you suck savings out of the economy. Sure, you can do this once, twice, 3 times, but in the end of the day, in 2007, the savings rate hit 0, and then it turned negative. What does it mean? It means simply that capital is not replenished. In other words, you consume more than what you produce, and this means that the capital stock, houses, factories, roads, bridges, whatever is the overall capital structure, the most prominent case is refineries, these are not maintained. So rather than investing at least to maintain their value, you don't do even that. Alright? So that's the meaning of it. So nothing else. I mean, massive credit expansion is good enough to lower the overall savings rate. I mean, that's exactly what's happening. All right, let's move on. Okay, this is the E-mini S&P. Okay, I remember, guys, we did this from last time. This is where the market crashed. This is where the PPT actually intervened. Let's scroll further and see how far we go. Alright, I think I explained this one last time too. SSEC, that's the Shanghai Stock Exchange. This is a wild, and I mean wild real estate bubble. You see in 2000, the Shanghai Composite, it was at 1250. By the year end, it is at 27. That's a good 100+% return. If anyone would remember, it went all the way to above 5,000 in 2007. So when a stock market gives you good 100% return, you know that something is fundamentally wrong. It may be a bubble, or it may be, as it was back in Germany, in Weimar Germany, that the currency was rapidly depreciating, in the sense that the mark was falling so fast that when you actually measured the rise of the stock market in dollar terms, because the dollar back then was stable, gold-based, 1921, 22, 23, it was actually falling. So this indicates either some massive credit expansion with all of its concomitant problems, or it means that there is some inherent flaw in the currency. Usually these two go hand in hand, as it is the case in Bulgaria. We're on the currency board, we're expanding credit at 50%, broad money supply goes at 30%, yet we're joined at euro. So our stock has gone up at least up until sometime in 2007. More than 100% in 1 year, and this signals that something's fundamentally wrong. Here is something, let me backtrack here. I had a conversation with one of those new economy guys in Bulgaria saying, oh no, that would be September. It is just getting a whole lot better. We got 100% return over the last 12 months, but it's getting even better. And I asked him, well, how could it be getting better? I mean, how do you get, how do fundamentals possibly improve 100% in 1 year? One and only way is that profits increase by 100%. How is it possible to increase profits by 100% when we know from 200 years of history in the greatest of all economies in the world, that would be the United States, that profits grew by, I don't know, 3, 4, 5% annual basis? In other words, the share of profits relative to the overall size of the economy didn't rise that much. For 100 years, the share didn't change a lot. This means that profit growth was more or less the same as long-term economic growth. The economy grew at 7%, profits grow at 7%. How is it possible? And you say, oh no, now they're doing all of these things and whatnot. The rational markets store, and markets are discounting the future. Say, wait a minute. If they are today discounting the future, and indeed it is true that it's going to go up by 100%, are you telling me that last year, 12 months ago, every single player on the Bulgarian exchange was dumb and stupid and couldn't see that then, but they saw it 12 months later? You see the logic? Anytime you have a major, and I mean a gigantic move, you always ask the question, are the players now a lot smarter? Do they have some phenomenal information which 6 months ago they didn't have, or a year ago they didn't have? So the point is, when prices increase by, or let's say 100% or double in 1 year, either back then they were stupid, incompetent, or just couldn't see, or now they're stupid, incompetent, and can't see. But it can't be both, because fundamentals can't double in 1 single year. Of course, the answer to this is simpler. It's called a stock market bubble. It's happened hundreds of times in history, happens now in Bulgaria, and it will keep happening over and over again. Alright, so you got yourself the bubble here. Those in the other class, you will hear Jim Rogers, one of the top authorities in the world, also on the Chinese markets. He called it an incipient bubble. So, in late 2007, he says we have an incipient bubble. It doesn't mean it crashes this month or next month. It may last for another 2 or 3 years. But the point is that you do have the bubble, and that's a very nice way. So, excessive stock market growth must always be suspect, because the fundamentals cannot justify it. Alright? No matter what the underlying cause. Let's move on. See what we got. Alright, so we got silver. Alright, so this is the triangle. I think we discussed it last time. And here I have a strong resistance, 14.15. In early January and early February, this resistance which held, notice, from April 2006 all the way to 2008. In other words, the resistance was significant for almost 20 months. It was finally penetrated, meaning it broke out of the resistance. It broke decisively all the way to 1750 by yesterday. Alright, let's see what we have here. What we have here is so this is silver in euro terms. Well, you can see what's going on with silver in euro terms. Silver is not here. This indicates here weakness of the euro. This indicates that the euro has been holding fairly well, but the expectation is that it's going to break out. In other words, over here you have to understand, in 2001, 2002, 2003, the ECB has been very tight on monetary policy, in the sense that M3 grew modestly, 3, 4, 5%. And when M3 grew by only 3 or 4 or 5%, commodities were not going up against the euro. So at that time the euro was a sound currency. Today we know it is not anymore a sound currency. Hong Kong dollar is a lot better, right?
Well, it's pegged to the dollar.
You guys better depeg it, otherwise you're going to get in trouble. Just like the Saudis and the United Arab Emirates. Qataris are also talking about depegging. Alright, let's move on to the next chart. Let's see what's next. Okay, so this is the S&P. Let's see what we have here. This is good for cyclical analysis. Notice the time span from 1870. Why do we choose 1870? Well, a little before that. What's magic? Every goddamn financial analyst uses 1870. Why not 1860? Why not 1850? Why do they all stick to 1870? This is a great conspiracy amongst all financial and economic analysts. What is the conspiracy? What's the name of the conspiracy? Wow, I thought we were American university in Bulgaria. Alright, conspiracy is called the Civil War. 1860s was the US Civil War. During the Civil War, people thought the economy was screwed up, all right? There was not too much of a production. Production was mostly military, taxes, everything. There was inflation, hyperinflation, all this kind of stuff. So, during a war, you really don't want to get and use war data for many years and make a lot of conclusions out of it. It is not conspiracy. It is sound, common sense logic to exclude a multi-year war. So once you exclude the war, you try to get a year, 2 or 3, stabilize the banking system, stabilize the financial markets, and then you can make or begin making a meaningful analysis. Is this clear now? Alright, so what do we have here? All the way to 12/31/05, so it's 06. So what we are seeing here is the Standard & Poor's, and it is adjusted for inflation by the CPI. So this is one of the best charts for secular analysis. You see here one major run-up, correction, and then you see a secular run-up here from 1880 all the way to 1900. So you see a 20-year bull run or bull market. You also see that you had a major correction all the way here. This night, let's see, I don't see the date in here, but I know this is, you see, 20. This means 1920. 1920 designates 1919, the end of World War I. So during the war, the markets are jittery, and the government is extracting extra resources. So markets aren't usually doing well during wars. That's just a common sense lesson. So once you hit the bottom, you see that it's rising all the way to 1929. Now what you see is that all the way to 1929 was not a pure, beautiful straight line. There was one, we call it a correction. There was a second correction in here. So you get this one all the way over here. This is the Great Depression up until 32. Again, some economists like to say that the Great Depression ended in 32. Some will say it ended in 42 with US's involvement. Again, timing of the war is not our concern. Our concern is the end of the secular bear market. Can anyone see what the end looks like? Well, we can point this to here, possibly this one, but the timing of this particular analyst, I'm trying, what is it, I can't really read it, is that he has dated this one, 1942. This one, he's dated it to be the bottom of the secular bear market. So, secular bear market started in 29 and bottomed roughly in 42. I would personally date it here at 46. World War II was over, but here's the deal. There are wars and wars. Civil War was highly destructive. It destroyed productive capital. Factories, houses, farms. That was a different type of war from World War II. World War II was not on US soil. They fought outside. So not only there was no destruction of productive capital on US soil, on the contrary, government war spending boosted the economy. All right, so they actually had to create a lot of factories for armed production, etc. So you may want to date this one, you may want to date this one, doesn't really matter. The point again is the dating, and the dating is whether you take it from 42 all the way, and here is the key. You have one little peak here, you have a second peak here, you have a third peak here. This guy has put in this top in here, which is roughly in the 60. Other authors prefer definitely to put the 65 or 66. The preferred method for many authors is to get this this ratio, not inflation adjusted, but adjusted against gold. And when I get it adjusted against gold, the peak turns out to be 66. Okay? So what's the secular market from 66 all the way? I'm trying to see, this has got to be 80 or 82. You see, again, the tricky part is that once you get the stock market adjusted for inflation by the CPI, you get a very distorted picture. What this is telling me here is that the bottom was in 79. This doesn't make sense to me. It makes sense to be 80 or 82, all right? So again, the point is still one secular cycle here, 20 years, another secular cycle here on the way down, roughly, I don't know, 15 years. A secular boom all the way here, roughly 10 years. A secular bear market, roughly 20 plus years. A secular bull market, almost 20 years. And a secular bear market, about 15 years. Now, from 82, that's my timing. Of course, you can use the chart starting Amy, 76. You have all the way here a big sharp increase to, what is it, 19, I'm having difficulty reading it, 95. This is nonsense here, guys. I mean, the inflation adjustment is really good. The peak is all the way, we all know it, 2000. So, we've got those all the way to 2000, and then from 2000 it steadily goes down. Again, the point is you have from 82 to 2000 an 18-year bull market. Again, we may get only a 10-year bear market. Could be 15, it could be 20. Again, hard to tell. We got to be looking at fundamentals, ratios, etc. Let's move on. What do we have here? This is USB. If I can read it correctly, the USB is the government bond. Can you try to hit the plus sign? Okay, thank you. So USB has got to be the long-term US government bond. It's really hard to read, but my good understanding is this could possibly be, from what I remember, it doesn't show, it's not your fault, doesn't show in here, is usually a 20-year of a bull market for bonds. 20-year bull market means that 1980 and then 82, what happened was the peak of the inflation. The peak of the inflation in combination with the peak of inflationary expectations results in very high yields, very high bond yields. Very high bond yields always correspond to very low bond prices. So, as yields go down or went down from 1980 all the way to 2000 and now falling further into 2006 or 2007, bond prices must necessarily go up. So, one very important conclusion here is that it is extremely important for you to understand the financial environment, which means, are interest rates in a long-term uptrend or are interest rates in a long-term downtrend? Interest rates in a long-term downtrend imply rising bond prices, and they also imply rising stock prices, because when interest rates go down, the discount on stock dividends also, discount factor goes down, which means that the value of the stock, the fundamental value, being discounted by less implies a higher value for the stock. So, usually, bond markets, bond bull markets, correspond with stock bull markets, but not always, usually. So that's a typical consideration. Let's move on and see what's next. Alright, that's again, okay, this is the USD, this is the dollar, this is the dollar. We are zooming in now only for 2007 all the way to mid-2007. And you see how this guy has drawn here a trend channel on the way down. You see here it was around 80, 81. The big question is, if we look later at a long-term dollar chart, is it going to break down below 80? Well, now we know it broke down below 80. Let's move on and see what else we have here. Oh, okay, this is Elliott wave analysis. Now, Elliott wave analysis, let me make a little introduction, is completely, and I mean completely different from the standard technical analysis. Elliott wave analysis works with waves. The waves are usually 5-3 pattern. Let me draw here, where is the thing that I wipe with? Okay, here it is. So let me wipe it and draw for you to understand what is the pattern looking like and how do we develop a Elliott wave pattern. This, what you have to understand, is a completely different school of technical analysis. It has some overlaps with Dow theory, but Elliott waves, the big scholar in the field is Robert Prechter, highly renowned, top guy. He's got a couple of great books. He's in what's called socioeconomics, which is social economics. He looks at the culture and other features, and he analyzes from a cultural lens the economy. And from that point of view, he tries to make economic analysis. I'm just giving one example, not necessarily his, but to give you a flavor. How do we analyze culture? Well, one example will be consumerism. The rise of consumerism will definitely indicate some new type of stage in the overall economic thinking. The rapid rise of use of credit cards will be a different type of or phase or stage of macroeconomic development. A different type of, let's say, cultural economic, cultural development with economic implications is, let's say, MTV, 1980. You got the MTV, you know culture is in decline. Of course, MTV is symbolic with cultural decline, right? Right? I mean, the point is, okay, you know that you have some other. The point is, he's trying to make economic and macro analysis from a cultural point of view, as opposed to, again, another cultural point of view will be integrity of CEOs, CEO bonuses, or percentage that executives in investment banks distribute out of profits to themselves. You know, they distribute 20% and the percentage increase. This means that greed has gone a step up, and this can't be that good after all. So, let me get back. I do have a little thing here to write. So, what is it? Well, they are saying there is one big wave up and one wave down. That represents one cycle. Of course, the theory refines it that the upside will have 5 waves. So, you're going to have wave 1, right in here 1, wave 2, which is a downside, a correction, wave 3, which is the major, big one, wave 4, another correction, and then wave 5, possibly higher than 3, but not necessarily. Now, on the way down, there's one major leg down. There is a major bear market correction too. And then you have the major leg down possibly with a washout here. This is 3. So, what you have is one big wave up and one big wave down. And this is on the way up, you have the 5, on the way down the 3. Now, this might go one step further. They'll say, okay, if this is, let's say, 10 years and this is 5 years, this here will represent 3 years. This will represent 1.5 years. This will represent 3 years. This will represent, let's say, 1.5 years. And this will represent 2 years. Now, this phase here will have the same 5-degree pattern. There's going to be one up, down, and then one up again. So here they'll designate 1, 2, 3, 4, and here it will be 5. So you see that it becomes 5 waves within the 2 pattern. Then within that wave you're going to have the 5 pattern. Here you'll have the 3 pattern. So now this little wave here will have 5 within itself. So the waves get within each other. This process of getting one within another, and when you use a big picture and then you get it smaller, and when the smaller picture looks like the big picture, there is a special field in mathematics which is called, anybody? Fractal geometry. Fractals. So fractals or fractal geometry. So this whole Elliott wave theory is based entirely on fractals. It's a completely different worldview, but in a sense it resembles Dow theory in that this big first wave interpretation here is the smart money interpretation. This is the big money, and this is the dumb money interpretation. So in that sense, the 3 stages of the bull market are more or less similar. Alright, so here is the interpretation now. You see now how they say A, B, C. Then you have here again, what is this? W, then X, A, B, C. Again, different interpretation. Sometimes the interpretation is A, B, C, D, A, B, C, D. Then the interpretation is X, Y, Z, X, Y, Z, or D, W. Again, different authors. You see here is A, B, C, then W, X, then A, B, C. Then you have, again, Y, A, B, C, etc. So that's an interpretation, Elliott wave analysis of the US dollar index. So the Elliott wave analysis is their interpretation of what each wave looks like, and etc. Now, let's try to provide a different type of technical analysis as a superb illustration of where the dollar is going. In October and November of last year, 3 months ago, there was a major discussion amongst the university, amongst professors, that we gotta switch out of dollars and into euro, in other words, to euroize, because of the terrible weakness of the dollar and the losses sustained by university, faculty, etc., etc. Alright, so this discussion reached, if you would remember or know anything about it, the crescendo with the bottoming of the dollar on the market. Well, as the dollar has been rising, the topic, guess what? Is forgotten. The topic is forgotten, and guess what? Today we had a faculty meeting, no one even asked about it. Hey, are we switching actually officially to euro? No, nobody cares. So, if this is the type of mentality, you know right about when the topic is forgotten, that's where the big next leg down is coming. In other words, when you have a major fall of the market and everybody gets worried about it, the market needs for some time to correct, to calm down the losers. So, once they calm down, they get dozed and they are not careful, the market makes the next blow. This is exactly how it works. This is the purpose of the market. The purpose of the market is to extract the most out of the majority and to funnel it to the smart minority. So, essentially the market is kind of getting people lazy and unalert. Now, we'll remind me please guys next time when we get to real world stuff is Bulgarian Stock Exchange. Bulgarian Stock Exchange had a phenomenal shock on the way down. Well, can you go and click the Internet Explorer button here and then go to www.investor.bg. Let's illustrate. This is really great. I was reading last night Saturday's Bulgarian newspaper called Banker. And these guys are saying, finally the market calmed down, finally it is going up a little, now we're finally confident that the storm is over. So when you, now please click on this chart here of Sofix, and is it coming up? Okay, so it's loading. So this is Sofix, this is one of the major Bulgarian indices. The other big one is BG40. It's going to give us like a 3 or 6 year chart, and then we're going to zoom in over the last year. So they are saying, okay, the storm is over and now we're poised for a meaningful recovery. This is called how? Market sentiment. So when the market sentiment and everybody gets really comfortable, that's where the big leg down is. Now this is, you can see a, I don't know, 3-year chart. Let's click on a 1-year chart here, 1 year, so to provide a better illustration of what's really going on. So that's a real-time analysis actually the chart includes today. So first major leg down. Everyone is scared the hell out of it. Panic on the market. So what they get to do is you get a full month of relief. You see, November 1st all the way to January, my apologies, 2 months of relief. So for 2 months, everyone is comfortable, everyone is great, the market is recovering, no problems, the storm is over, and then wham, in just a couple of weeks, market major collapse. How major? Well, just check it out, guys. From 1700 all the way to 1400, that's good what? 20%, right? So it's a good 20% loss. So 20% loss in 3 or 4 weeks. I mean, that's a major loss. You got to understand that. And that is on top of another 15% loss. So there you have it. 3-4 months, the market is 30-40% down. This is called a classical bear market, all right? So now, here is the discussion. Over here, they say, okay, since whatever, the storm is over, market is going up, market is recovering, and here is another key word that you gotta be always alert. Market regains its confidence. Now, when market regains its confidence, you know the next big hit is on its way. So, when they are worried, I was reading 2 weeks ago, they were worried, well, the market may go down and we don't know, we're not sure, and all this kind of stuff. When you see that even brokers and guys like this are a little bit worried and cautious, you know the market is going to be recovering a little bit. We call this a correction. This is called a bear market correction. So a major step down, a relief rally. This is also called relief rally. And the purpose, the meaning of the relief rally is to sucker in those that, that got scared out of the market. The purpose is to get them back in the market so that they can sustain even more losses. You got to understand, the stock market is not a lottery where everyone is a winner. The stock market has the purpose of shaking out those that are not competent and well trained. So over here right now they're saying, okay, the market is stabilized, everything is fine, we're confident, the storm is over. Again, they are repeating the same garbage that they delivered right in here. I read and sense the same sentiment. So we're poised for yet another major collapse. Now, it may come tomorrow, it may come next week, it may come 2 weeks. That's not as relevant. What is relevant is that there was a wild bullish sentiment on the way here. The bullish sentiment did not disappear. They were cautious. Nobody said sell, 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 right? Nobody was saying get out at no matter what the price. They were cautious, and once they regained their confidence, a major leg down. Cautious, now they've regained the confidence. Again, very hard to predict. This is going to be tomorrow or 2 weeks from today, but a major leg down will be more or less necessary. So that's an example of real-time technical analysis. All right, let's get back, just click at the bottom here, the USD, and see. All right, let's move on to the next chart, see what we got next. You guys, someone's got to tell me when it's time. Is it time?
Yes.
Well, I guess then we continue next time on Friday. And I'm planning one session where we're going to get real-time indices, meaning Dow Jones and US dollar, oil, gold, and all this kind of stuff. And we'll try to provide real-time interpretation. I also have updates, so I will slip one lecture or even 1 week, but that's okay. No problem if we get an extra week for technical analysis to do some real stuff. Did you stop it?